All right, everybody, welcome back. It's episode 108 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neil. Neil, monster interview today with some big news recently in the private lending space.
Yeah, these guys have made a beast of an acquisition. They have a lot of knowledge. It was really interesting to be able to actually get them on the mic. I was pretty excited about that.
Yeah, 100%. We had Neighbourhood Holdings CEO Taylor Little and Senior Director of Originations Jared Stanley. So two senior guys that were heavily involved in the acquisition of Fisgard Asset Management a couple weeks ago. And we went deep on it. We got some great insight there. They're going to be a combined $750 million AUM, one of the biggest private lenders in Canada. And it was likely the biggest ever acquisition we've seen in the Canadian private lending space. So just really cool to dive in on that. We also touched on some things that came out to me, Neil, was a bit of the legacy around Fisgard, obviously a major brand name around for 30 years, and they're going to live on through their EMD for Neighbourhood Holdings as well. And we kind of wrapped up on talking about the Canadian Alternative Mortgage Lenders Association, CAMLA, as well, which Jared Stanley is heavily involved in and is a member of the board there. So anything else stick out for you, Neil?
Yeah, I think the thing that was interesting to me was the romance of deal making. It's something I think I've always thought about, but it's a little bit contrarian to what you might expect. So I think it's an interesting story to listen to. Also, the outcome of once the deal was announced, I think what happened for their business was not also what I would expect. I mean, maybe it seems obvious, but it just sometimes I think almost the opposite takes place in an acquisition of a business. Yep. So again, another thing that was really interesting. And then finally, my favorite part is Taylor's as pessimistic as I am.
I knew you were going to love that. Yeah. Hates the market conditions right now, telling us to protect ourselves. But no, I loved like the art of the deal that they got into there, and how it, obviously, we talked about, different terms and how they came to, but it was really like, flirting and a budding romance that kind of led to it taking place, which was really neat to hear.
50 Shades of Lending.
There's the title for the episode. All right, everybody, enjoy the interview with Neighbourhood Holdings, and we'll see you soon.
Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neil Andreino and Ryan MacNeil. Enjoy.
All right, Neil, we've got a super exciting episode coming up here today. We've got maybe the biggest acquisition news ever in the Canadian private lending space, with Neighbourhood Holdings acquiring Fisgard Asset Management a couple weeks ago, and we've got the guys here to talk about it. So we've got Taylor Little, CEO of Neighbourhood Holdings, and Jared Stanley, Senior Director of Originations. Guys, thanks so much for coming on, and welcome to the show.
Thanks for having us
here.
Awesome. All right, let's jump right into it. We've got a pile of questions to go through. But why don't, Taylor, maybe you can kick us off and just give us a little bit of background about yourself, your career path, kind of how you landed. We always want to know how people landed in the mortgage space, and specifically why you joined Neighbourhood as well.
Yeah, you bet. And for this kind of question, it might be better that Jared goes first, but I'll take a crack because Jared started before me. And
it's true.
Jared, why don't you walk through, because the timeline here is actually really interesting and important. So maybe just to kick it off, Jared worked with Alex Conconi way back in the day, schlepping around Victoria, trying to get some mortgages done. Jared?
Yeah, sure. Yeah, no, that's funny. So I would say also Alex got his start really young in the mortgage industry. So did I. I was licensed in 2009, and I was 20 years old. So I was working for my dad's brokerage in Victoria, and focused on typically online lead generation, following up inbound leads, doing digital marketing campaigns, and also, of course, brokering. So I definitely learned a bit of resilience and the art of hearing no. It was a lot of smiling and dialing, and really got rid of a lot of my call reluctance there, because I was this young guy calling internet leads out of the blue. And, I had to hear no a lot, but also then I learned how to kind of build trust through with customers over the phone. During that time, Alex was actually going to UVic, and he wanted to enter the brokering industry. And so we had the opportunity to work together. He'll say it as well, as actually I was his boss, his manager to begin with, but the tables have turned now for quite a long time. So he hung his license at my father's brokerage, He finished up his degree at UVic, and then he went over to Simon Fraser for his Master's of Finance. He finished that up. He gave me a call and said, hey, I want to spin out this alternative lender called Alt Mortgages. And I was actually at RBC at the time. I wanted to migrate away from the family business. I thought the easiest route was to go to the bank, not another competing brokerage, save my dad's heart that way. But while I was at RBC, I was actually, I think, the youngest mortgage specialist at RBC at the time, or even ever. I was like 23 or so. And I was actually really happy to hear Alex's call because, I was just a mortgage specialist jumping between branches and everything like that. And so Alex gave me the call. I came over to Vancouver and I was working as a business development officer and underwriter. 2 years later, because we got so busy, we spun out Neighbourhood Holdings. And Taylor, I don't know if you want to go into the funny story about how we came to that name, but the long answer short is we were actually funders of other commitments for other lenders. And we started doing quite a bit of volume. And they said, hey, can you guys just come up with a friendly generic name? And so we came up with Neighbourhood Holdings, which is as generic and friendly as you can get. I don't know if it's related to Spider-Man with the friendly neighborhood Spider-Man, but
let's go with
but
that.
Definitely it's stuck, and we continue to grow, and now brokers know us as Neighborhood Holdings or Neighborhood or NH. So it's kind of my background in a nutshell, and I guess started as business development officer and underwriter. Now I'm the senior director of originations. What I love about our company and working with people like Taylor and Alex and Hash is this is going to sound a little bit corny, but they always believed in me. And so when you have a group of people that believe in you and support you and just was always rooting for you, you can really, again, not sound corny, but take on the world or take on the Canadian mortgage industry. So yeah, that's me in the background.
Very cool. Very cool.
Nice.
Just to clarify before Taylor, you jump in here. So Alex is the founder of Neighbourhood Holdings. Is that correct?
Yeah. And it really was started off of the Conconi family office. So the saying there is that the family was already rich. When that happens, you got to decide what to do with your capital. And Alex's dad had a really nice exit from a company called Canadian Securities Registration Systems, which essentially was the back end for personal property registration in Canada. So he found a way to digitize that process. If you've ever leased or financed a car, for example, there's a little charge on it. That charge used to go to Bob. And that business eventually sold. And, like a lot of successful entrepreneurs, you got to figure out what to do with your capital after an exit. Are you going to redeploy it, start a new business? Oftentimes you don't. You've been an entrepreneur for, in some cases, many decades. So what are you going to do? And the thinking there was, Bob had been doing a lot of his own lending. Alex had been helping him out, kind of in that 08, 09 era, because a lot of lending was not working out the way they had hoped. And coming out of that cycle, the thinking was, look, why are we reaching for yield? Why are we lending on, sort of real hairy stuff that no one else is looking at, kind of true classic private lending? Why don't we just try to get, and I think, Jared, our original rates were 6%. Like, why don't we just get 6% on residential Canadian real estate, beat inflation a little bit, have it be liquid, not have headaches. We're not trying to foreclose on a farm overseas or something like this. So I think the real kernel of Neighbourhood came out of that. Where I intersect with the story is I worked at a law firm called Stikeman Elliott, and Alex happened to be a client of mine. And as he was looking to put together a formal family office, he said, hey, do you want to join in as a partner here and help us co-found something? Not really at the time. Funny enough, the pitch was not even really sure what it's going to be, but it'll be something. And on my end, I loved my job, loved where I was working, but I thought, well, that sounds interesting and exciting. And I'm young enough to make a switch that if it doesn't work out, I'll just go back to practicing law. That's always there. So I joined in 2015. Jared mentioned we have another partner in this, Hash Malbehosen, and we started Neighbourhood. We basically took it off the family balance sheet and invited some friends and family to invest with us. And if you're a Seinfeld fan, yada, 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 here we are today. Just really been grinding it out. It's now been almost exactly 10 years. I think in the next week or two here, it'll be our actual 10-year anniversary as Neighbourhood, and we're gonna keep building here.
Very cool. Very cool.
Nice.
Let's dive right into the acquisition here. So, I mean, Fisgard, massive name in Canada already. Obviously, both of you guys based in BC for head office, and you guys have created one of the largest alternative lenders in Canada now. So, I think I saw about 750 million in AUM, about a 65-person team now. So, can you kind of maybe just go right into like how this deal came together? Like, were they looking to sell their business? Was there multiple parties interested? Kind of how it came together, and then we can kind of take it from there.
So we caught wind that there was the potential to maybe consider selling on Fisgard's end, and internally at Neighbourhood, and I think even publicly to some degree, to the extent what we say is public. I don't know how many people listen to our webinars or listen to me when I'm speaking, but we've long thought now that M&A in our space would be a thing. And the reason for that is there's a bit of a generational turnover. A lot of mix or mortgage investment entities are founded by former mortgage brokers who are now starting to think about retiring. There's not a lot of 20-year-olds starting mix today. They're maybe starting brokerages or digital something or other, but not a lot of mix. So you've got a bit of a trend just demographically. The other thing that we're finding in Neighbourhood is just the cost of doing business is getting higher, and a big reason for that is the regulatory burden. We just launched new rules from FinTrack, I believe a year ago now, and on our end, we hired a full-time senior manager of AML to help with that, and we've developed some tech around it as well, and that's a cost. So if you're a smaller fund, these things really start to chip away at your margin, and they make it kind of a less exciting business. You layer on the fact that we are not in a good housing market right now. You kind of have to look at this environment as a business owner and go, do I have the stomach for another 5 years of kind of grindy evolution of my business where maybe we don't grow, maybe I'm working through some foreclosures. It's just maybe not the most fun time. Probably there's going to be some sellers. So that was a bit of a thesis we had internally. So we just reached out to the Fisgard group and started with a coffee. And from there, got to know each other well, threw some offers back and forth. There was some, call it friendly, almost like corporate dating drama behind it, at one point. And the team at Fisgard, or what was Fisgard, because in past tense they were Fisgard, we're all Neighbourhood now, but they'll joke that at one point they walked away and said, guys, really nice meeting you, but we're just going to reconsider our options. And we said, no problem. But then all of a sudden a package appeared in my office, and it was a box of Fisgard t-shirts. There was a note in it that said, there is still a beacon of hope. And the word beacon is relevant because when we had pitched them on the deal and we put together a deck and talked about how the future would look really great in a joint business, we called it Project Beacon, and that was in reference to the Fisgard Lighthouse, which is part of what the business is named after. There's also, I think their first office was on Fisgard Street in Victoria, which is kind of a cool street. So we saw that. Rayford also included their Canadian Mortgage Fund of the Year award and taped over the word Fisgard with Beacon. So we sent them a package back without a call or anything, just saying, with a bottle of champagne saying, if Project Beacon is a success, crack open and enjoy, along with some coffee. And one of the bags of coffee from Pallet was called Top Shelf Roast. And we said, hey, we think together we'll be top shelf. So a little bit of flirting.
It's like a long distance love relationship.
Got back to the table and hammered out a deal. And I think we're both really happy with it. As to whether there were other people looking at it, I'm sure there were, but there's a lot more art, I think, to deal making than science. I'm sure that, what we had on a spreadsheet was compelling, but I imagine, there probably would have been a lot of people interested if they had gone to market with an investment banker and everything. But what they saw in us was kind of the next generation to take over the business and drive it forward. A lot of aligned kind of philosophy when it comes to lending, when it comes to team culture. It helps that we used to admire Fisgard a lot. Jared and I used to have them on the comp sheet. And in fact, Alex dug up an old email that he had sent Bob in 2009 referencing Fisgard's new website. And he goes, I really like this. Yeah, I like these guys. So it just is a good fit. And so far from putting these businesses together, we're still feeling that. Maybe you guys will have a question on it, but integrating is an interesting process, but with really great cultures and two great teams that are excited. And I think the other thing we're seeing in this deal is it's really reinvigorated people. It's even reinvigorated me. It's just exciting to work on something new. There's a bunch of new people, new ideas. We're putting technology together. So that's sort of the folklore. And I do hope we do whatever award that is, Canadian Mortgage Fund of the Year. I hope we do win it, to really round out the mystery box story. So it's been fun. It's been fun.
That's a cool story. And I agree. I think deal making requires a lot more than, to your point, just a spreadsheet and numbers going into it. But on that side, just out of curiosity, how did you guys go about valuing the business? Coming to an offer, was it as simple as here's an EBITDA multiple, slide a sheet across the table, or was there more to it?
Yeah, I think there's a little bit of that for sure. Obviously, there's even just what can we pay? I actually had sent Rafer at one point before we even put an offer on the table. I was reading a book called The Whole Story, which is the story of Whole Foods, John Mackey's kind of autobiography. It's really interesting. And Whole Foods, it's not well known, but I guess in the early days, they did a lot of M&A of just buying up kind of random organic grocery stores. And it was really about finding kind of fair deals. And for us, it's look, here's what we think we can pay. And, here's why we think it would be a fair price. And, still have to line up financing and a few other things. A unique feature about this deal is the old owners of Fisgard are now shareholders in Neighbourhood. So there was some equity trading hands. It's primarily a cash deal, but one thing we were really pitching them on was just that future alignment, because we believe in our growth prospects. We believe in our team. And when you're looking at a deal, part of it is, well, maybe there's a second kick at the can down the road. I mean, we have no intentions of selling Neighbourhood, but there will be growth in Neighbourhood. And so we were able to share a little bit of a vision with them as well, which goes back to that art point of here's what we think the future could look like. And if you guys are excited by that, let's keep talking. And if you're not, no worries. And so I think it's just a combination of everything. A little bit of, we definitely didn't buy it for $1. I think we paid a price that both sides are probably equally happy and unhappy with, and that's probably
a good negotiation.
You're this is about right. And even philosophically, it's not, we were, neither side was ever sort of negotiating to the last dollar. It was just how do we make this make sense? Which ironically is kind of the approach to our lending environment. It's the deals just have to make sense. We're not restricted by any specific mandate. It just has to make sense.
Yeah,
that makes sense.
Just curious, if you can share, did Fisgard end up maintaining any portion of the equity in the deal? And also, is any of the leadership team from Fisgard, Hallie or Rafer, are they coming over to join Neighbourhood as well? Can you kind of speak to those points?
For sure. So yeah, there is some, the owners of Fisgard rolled a little bit of equity into Neighbourhood. So there's some shared ownership going forward. In terms of leadership and team, everybody is staying on, including Rafer and Hallie. We're working out just how that works, because this is that integration side too. You've got two executive teams, and I'm the CEO. Rafer was the CEO before, and so Rafer and I have had lots of conversations. How do we work together? How do we add value? I know for him, he's quite excited at the prospect of working with this team and almost spending more time working on the business and not in the business. We've got just such a strong group, and now that we've doubled the team, essentially it's even stronger. So same with Hallie. Jared can elaborate a little bit, but she's got to be one of the most connected people in the mortgage industry. Mm-hmm. And that's something that we were missing at Neighbourhood pre-acquisition. Is Jared is also very well known in the industry, but doesn't have the ability to call every broker owner at 9 p.m. and say, let's go grab breakfast tomorrow and figure out how to do more deals. We're really strong on that kind of digital, just call it broadly the digital side. So we've spent more of our energy and time building out tech and broad scale marketing tools and sales tools than we have doing the kind of hand-to-hand top of the house relationship building. And similar to Hallie, Riza is also extremely strong in that domain. So again, that was kind of one of the quote unquote synergies that we highlighted early on in this deal, is that they're doing sales a little bit differently than we are. And that's great. Like if we were all just doing the same thing, then you got to wonder how it's accretive. But there are a lot of things that they were doing different, if not better than us. And by bringing this on, we're able to capture that. And similarly, with this new group going forward, they're going to be able to benefit as well. So it's exciting from that end. So yeah, everybody's carrying on, and one person on their team, for example, was running the underwriters, but he also has a really strong finance mind, and we already have an underwriting manager, or had one. So now we've created some new roles for people as well. Like we can expand our product box, get a little bit better on pricing and more nimble on pricing and that kind of thing. So this is where the scale really starts to, I think, kick in. We're excited for that.
You're mentioning that Neighbourhood was a bit more tech forward than Fisgard. With that being said, it looks like Fisgard is going to maintain doing the EMD role for the business. Is that just better systems and processes, or a better team on that side that you want to handle it? Or was it they already had tech in place? What does that look like?
Totally different altogether, actually. So okay. Neighbourhood has an EMD, or had, and it's now its name to be Fisgard Capital Management. The reason why we chose to change the name is because Fisgard has north of 2,400 investors that they've brought on through that entity. And our view is that the brand recognition for that dealer is quite a bit stronger than what Neighbourhood had. Neighbourhood had something like 100 direct investors. We've got, hundreds of other investors, but they come in through the advisor channel or the institutional channel. And that's kind of another synergy here, is Neighbourhood's got this real kind of third-party network of people who allocate capital to the fund. And then we have an exempt market dealer because we want to bring people in like my dad or someone. We don't want to be referring them out. We just wanted to take them in. So that was not a real business for us. It was roughly like a break-even business. It sort of worked. Mm-hmm. But Fisgard had a real business. And we know with a retail client base, we didn't want to just rock the boat super hard and say everything's changing. It's like, look, you're still dealing with a Fisgard dealing rep. You're still getting statements with a Fisgard logo on it. So it was really more kind of tactical and where we thought the brands were. And then the other side, and it might sound soft, but it's real, is we did want to honor the legacy of the Fisgard brand. It's been around for 30 years or more than 30 years. And we just felt it would be a bit odd to get rid of it completely. So that was the home we thought was the right place. And, Neighbourhood is the broker facing brand, because we've just done, certainly over the last few years, maybe not over the course of our history, we've done a lot more deal volume. So we figured we'd at least have kind of equal representation in the market. But on the EMD side, definitely Fisgard has more of a hold with those investors.
In private lending, time is everything. The faster you move, the faster deals close. At Mortgage Automator, we build a platform that transforms how credit unions and enterprise lenders originate, service, and scale their business. No spreadsheets, no chaos. Just precision, automation, and control. From loan origination to servicing and investor management, every step is seamless so you can focus on what matters most. Growing your portfolio and customer base, not managing it. From AI to compliance and everything in between, Mortgage Automator is trusted by hundreds of private lenders across North America and is the highest rated platform on G2 and Capterra. Mortgage Automator, powering the future of private lending.
It makes total sense. I find it funny. Like Fisgard to me does sound like, for the older generation, it sounds like investment security. It's got that brand name and sound that I would expect, I think, or the older generation would expect, where they want to put their money or have dealing with their money. And not that Neighborhood's not a great name, but to your point, brokers would be maybe more excited for a name like that as like a new, fresh face, someone who wants to lend and be involved in the business. So I think it makes actually a lot of sense, and it was a smart play.
Thanks.
Just one more note on the EMD piece. So is Fisgard as an EMD going to be the exclusive EMD for Neighbourhood Holdings, or is Fisgard as an EMD going to be open to taking on other mix as well? I'm asking for a friend.
That would be a great question for our CCO. Right now, generally speaking, in the space, they're kind of captive dealers. Like you have it. But look, the future is wide open, right? We may find, like, we've never thought of our EMD business as being like a core activity. We've thought of it as being a supplementary activity, but maybe that's something that takes off and takes on a life of its own. I don't know. There's no plan for it, just to be clear, but it's there's a lot of work. Like this goes back to that regulatory point. There's a lot of work to onboard a fund and be able to sell it. Like there's a whole know your product process, and it's very involved. So anyway, for now, we're just trying to land the ship and make sure that we're fully compliant going forward with sort of the one EMD as opposed to the two.
Yeah, makes sense.
Totally.
Jared, I want to kind of pivot over to the product side, if we could. So obviously you're going to have more combined expertise with the combined teams here, bigger capital base. So can you talk about, any new products or markets you're exploring, whether it's, more alt business or a business, construction, commercial? Can you kind of touch on that a little bit?
Yeah, for sure. And just a little bit of background, like Neighborhood has done really well with our product, but was quite conservative. Typically we capped out at 65% loan to value. And oftentimes we'd be below 60%. So though we are super fast, and we are flexible, we did stop and play in that sub 65 sandbox. So with the acquisition of Fisgard, we can now go up to 75%, which is something, remember at the beginning of the call, I learned the answer of saying no. In the early years, going to brokerage offices and saying, hey, yeah, we do all these things, but only up to 65. There are so many brokers that said, you're not going to go anywhere with that product. But, now we're at 450 million. So we did go somewhere with it. But I'm excited, super excited, and our sales team's excited because now we can go up to 75%. The other change is obviously Fisgard had a larger geographic footprint than us, although Neighborhood is unique in that we lend in Quebec as well. So we'll be able to go into smaller locations as well and just support our brokers there. I think the alternative space is super hyper competitive right now. So everyone has to innovate. We will be innovating, and we won't stop. But one of the ones we launched with this product is just our Alt A program. It's really geared towards the broker that hasn't sold their broker fee or lender fee on an alternative deal before, and they really just want to dip their toes into the alternative space. We are just going to give a bank-like experience where we pay a finder's fee on it, and there's no lender or broker fee. So brokers unfamiliar with the space don't have to go into explaining that. Of course, on those deals, the rate is a little bit higher, and the term is a little bit longer, just to ensure that we recoup the finder's fee that we pay out. But we are seeing some traction with that and some positive reception. So it's going to be a lot of fun. To Taylor's point, we have someone in a product manager role now, and we'll be able to do a lot of great things because our team now, we've gone from 30 to 65. So we just have a lot more horsepower. And I think overall to the brokers, the key point is just we'll be able to say yes more and say yes faster.
Cool.
Are you finding that to be a problem at all right now? Like, is deal flow massive and you guys are turning down more than you'd like to?
Yeah, actually. So, I kind of, I put my foot in my mouth a little bit because I was just like, because in Neighborhood's underwriting team they're known for their ability of being super fast and ability to crank. Like, they'll get approvals out. I should say that it's not without discipline. Like, we have built a lot of tech tools to enable our underwriting team to move that quickly. Like, we have automated AML processes that flag things if there's like unusual income types or high risk income types. Also, all of our lending criteria are in the system. So if things are outside the lending criteria, it puts warning. So I just want to say that we're not just issuing paper willy-nilly. So sorry, I have to jump back. So note for speed, I've lost my train of thought, unfortunately.
Well,
you can edit that
where
out.
you're going, Jared, is we really rushed to close this deal before the MPC conference in Ottawa. That was our deadline, and believe me when I say it was a stretch to get there. I think virtually everybody involved in the deal, like all the professional advisors, were kind of rolling their eyes when we were saying that's when we were going to close, but we stuck to it and we got it done. And a big driver, maybe even the single biggest driver for doing this deal, was to kickstart originations, because we're in this market where there's just less housing volume, which means the banks are competing harder to keep volume or win volume. And you can even see this in origination flows as between the banks and a group like Equitable, for example. The banks are growing their balance sheets a little bit. Last I checked, Equitable was not. So we're feeling that. And the neighborhood has always felt this kind of restricted credit box problem. And I think we've done a remarkable job growing this business with one hand tied behind our back. So
Sorry. I remember what I was going to say. The way I put my foot in my mouth, and I was like, the neighborhood underwriting team's got it. No problem. They can handle the extra volume. But then once you onboard 35 extra people, and then you're also training a bunch of new people, plus you get an avalanche of deals coming through the door, it results in slightly longer turnaround times.
Well, that's where I was going to get is we did this deal to get more volume, and then we announced it, and we absolutely got whacked.
Yeah.
I had this dream either like on the flight to Ottawa or the first night in Ottawa. I was like, do we have enough money? Like, did we consider like some tail risk on this deal? What if we get $100 million of submissions in a month? What does that look like? We kind of assumed, and we have loads of capital. So like our balance sheet is super strong, but didn't consider the
administrative burden.
Yeah. Like how good is this going to be? So certainly the initial response has been better than we had expected in terms of volumes.
Yeah.
And going into it, we were a bit slow. So kind of to Jared's point, like, we've got capacity, even if we were to see like a 30% spike in volumes, we know what was the neighborhood team could just handle that on their own while the others are ramping up, while the new neighborhood members are ramping up. And then we just got absolutely smoked. So it's been a fun, like it's nice when you do a thing and it works the way you want it to, but then there's some pain that lives in other parts of the business. So I think we were maybe a bit naive as to what the market response would be, and then also our ability to handle that response. But that's a high quality problem right now.
Yeah, for sure.
That's a great problem to have. What about the acquisition drove so much origination? Like, what is it? Simply the news of bringing them together, or just Fisgard had such a busy pipe already? Like, what about that just cranked through the roof?
Yeah. Well, I think.
Sorry.
Well, Jared will have a more accurate answer, but in broad strokes, I'd say it's two things. One, we did a big pricing change in September, so the pipeline that was sort of closing mid-October likely is due in part to that big change that we made. And then two, we always expected that we were going to get a big marketing bump from the announcement. So to do it at the conference, to go and shake, hundreds of hands and meet a bunch of new people, certainly on my end, meeting a bunch of great people, it just resulted in more leads, frankly. So those to me were the big rocks. But Jared, curious, like what Jared actually sees every deal that comes through. So
I think Taylor captured it. It's just we already had a really strong marketing engine at Neighbourhood. To Taylor's earlier point, Fisgard they're really good at the top down marketing, whereas we were always bottom up. So instead of knowing, working with the top of the brokerage networks and finding exactly who we need to target, we just kind of mass market and get out there. So we have a very large, marketing engine. So announcing this news also, our broker base already loves us. One of the restrictions to Taylor's earlier point about the hand tied behind our back, it alleviated that problem. So it's like, oh, now our favorite lender, we can use them up to 75. So a lot of people opened those emails and answered those calls, and we were obviously posting it everywhere, and so it just got a lot of traction, created a lot of buzz.
Good.
I gotta say, guys, like having that news drop on the Saturday morning going into MPC just created such a buzz the entire weekend. It was really cool and really cool that you guys get to work it in for that timing as well. I'm sure that certainly helped with moving things along, moving forward as a joint business. But I am curious, and Neil and I have been talking about this recently. We actually had, I'm not sure if you guys know Benjamin Salmon. He's with Dabblecap Advisory.
Yep.
So we just had him on 2 weeks ago on the show, and he was talking directly about this, and he's talked about it in Canadian Mortgage Trends before as well, but just how he expected less new entrants to the industry and more consolidation, more acquisitions in the private and the mixed space in Canada. And it was just very interesting to see, days after we had him on, this news drops, and then we had, Alta West acquired Premier Mortgage recently as well. I was part of an acquisition years ago in Atlantic Canada, smaller firm, but you don't see it that often, right? And this was obviously massive news. So I'm just kind of curious to get your guys' perspective more from a broader, across Canada. Do you think the industry is going to continue pursuing more of these types of acquisitions? Are you guys going to be strategically looking for more of these acquisitions, or is this kind of like, this was the big one for us, now we'll settle in and then see what the next few years bring?
Yeah, and Ben definitely has his finger on the pulse, and I've had lots of calls with him. Really enjoy him. Like we said earlier, we figured this was coming. I think one thing that is unique about our group is we did this deal in-house. And I really want to underscore that it's hard to pull a transaction like this off. And it's hard also, I think, for sellers to wrap their heads around it. I know there's a lot of sellers out there who, if you own a MEC, you're probably doing okay. It's not a super complicated business, right? If you look under the hood and you really get into the details of it, it's quite complicated and interesting, but at the end of the day, it's just lending. It's aggregating capital and getting it out the door. So I think the point about new entrants is interesting because we often hear about groups that want to enter the space, and by no means am I trying to discourage that, but I think it's also underappreciated how hard it is to operate these days. And that's in part because of the regulatory burden. It takes time just to ramp a business to build a reputation, to build the workflows. So even if you come to market with $100 million or something, it's not as easy as it seems. So yeah, I think if I were a new entrant today, I'd probably want to acquire and just get that head start. Do I think there will be more deals in the industry? Yes, I know of a few that are in the market. Will we be doing more? Maybe. And I think right now I know right now the goal is just to stabilize this business. And absolutely that's what we're looking to do. It would be a lot for us to take on another deal like this right away. We also want to make sure that we build the right muscles. I was working out this morning with a friend of mine who's a trainer, and he's like, a lot of people especially athletes, have all these compensations so they can push heavyweight with bad form. But then when you get them to have good form, they fall apart. And I think it'd be similar to M&A, where you go, let's just nail this thing. Let's get it. The analogy I've used with the team, and it's from Jeff Bezos, and I love it, is let's build a heavy business. Like, you just want that foundation to be so heavy and strong that you can go do another one. And I think the interesting thing with sort of M&A or corp dev is once you've done one deal, your next deal probably gets a bit easier because you take the lessons with you. And the integration side, we're learning there too. And there's definitely things I would do differently in this deal. And I think that's always a fair comment, is there's just like, what lessons did you learn? Well, here they are. So if we were to do it again, here's how we do it. So I could see another one happening. Whether it would be this big, I don't know. Like, you start to get to this point where if we were to acquire another Fisgard, do we need a 100-person team to manage a $1 billion portfolio? And I tell you, the answer is no. Then you start looking at things like, could we just acquire a mortgage book? Or do we want to acquire like a pipeline of capital? Or do we want to acquire, like, Jared mentioned the credit box is a bit different. Like, what can we get that supplements what we have today? So don't know, but I'm just super proud of the team for pulling this off internally. And just to be really clear, like, the normal course when you do a deal like this is you hire an advisor. You hire a suite of investment bankers to help you do the deal. We had lawyers and we worked with our accountants on it, but we have in-house tax, we have in-house corp dev, we have in-house analytics, data, all of it. So we were able to run this, which means we can probably do it again, because it's also expensive to hire investment bankers. Yeah.
Mm-hmm.
Interesting.
Neil, a couple more before we wrap up here.
Yeah, for sure. Sorry, I'm just thinking about like your discussion of like breaking apart kind of the pieces of what a MIC is and buying like a mortgage pipeline or a mortgage book specifically. So on that note, would you look at buying a mortgage book and basically assuming the administration and seeing it through, like,
100%.
and just underwrite the whole book? Yeah. Interesting.
Yeah. Very cool.
And that would also be quite hard to value as well. Especially in our space where it's generally 1 year paper. How do you price it? And probably you buy it for par value. Would have to
contingencies.
Pardon me?
With contingencies kind of on.
Exactly. Yeah. I mean, there actually are ways, and people have done these, but it's just a question of like, what are you buying? Are you buying a book that's in distress? Well, then what do you pay for a distressed book? Or if you're buying a clean book, you got to wonder why it's for sale. We've definitely reached out to some groups that we know are facing some liquidity challenges and just saying, hey, like, if you need to free up some capital, we're open. We have a lot of capital and not enough deals. So I think from that end, we can kind of fill if we can, but so far haven't transacted anything like that.
It's kind of, do you think you'll get to that point with the private market? Almost like, because like the big five effectively do that, and with prime lending, they do that, right? Where they're packaging and selling off these loan books. Do you think you'll get to a point where there's firms basically just focused on origination and then selling them off to administrators, even to your point with the short kind of durations?
Yeah, whether it goes fully in that direction, I don't know. So we know, and you guys would know who they are. Like, we know that there's a couple of securitizations that have happened in the space, and that's interesting for us. We're speaking with the bankers that are doing that and can speak their language, and we're set up actually to do a securitization. And the reason why we're set up to do a securitization is we had set ourselves up a couple of years ago to do something we call correspondent lending, which is almost like an off-balance sheet form of lending. So you find an asset manager who goes, look, I like your space. I own a bunch of whatever, corporate bonds, commercial mortgages, but I'd like to put a sleeve of residential mortgages in there. Found you guys, like your brand, like your performance. Can you do that for us? But by the way, our cost of capital is cheaper than yours, so we don't want to invest in your fund. But can you put loans on our balance sheet and we'll pay you a fee to service and originate those loans? So we've done some of that, and we basically built the plumbing to do it. And the plumbing's hard. I think it took about a year to build, and that's just even getting like your tech stack ready for it. It's doing things like finding a third-party title holder who can hold title for you such that you can hold it on your balance sheet and then move the beneficiary over when the time's right. So yeah, I think we could see more of that sharing. And for us, regardless of what direction the market goes in, like we know what the cost of capital on the securitization is, for example. And depending on how you do it, it could be cheaper. It could be, a roughly even, or maybe even a bit more expensive. It's like a leverage function. But the thing for us that's really clear, and Jared knows this well because I'm bugging him about it all the time, is it's all about originations. Like you have to be able to meet the market and get in front of the market. So no matter where it goes, you got to win that. And for us, I think the nice thing in our space is it's not. I don't see OSFI. I haven't studied the budget yet, but I don't think there's going to be any real, and not that the feds control OSFI, but I think they can be suggestive. I don't think we're going to see any major credit loosening in Canada anytime soon. So chances are our space continues to grow. But I can also see the capital behind the space maturing and going, look, we're going to price these loans a bit more on a curve as opposed to like steps, because I think we're still kind of in a step environment. So there's that, but then we think about it like one thing Jared spends a lot of time on is educating brokers on what we do and why we're a useful tool or a solution to a problem they might have. And that's a big piece. If you're a prime broker, one thing we're trying to educate them on is work with us for your your client's transition event. We're easy to pay out. We're for the most part interest only. Really transparent on fees and how this works. And if you've got a client who just needs a 6 to 9 month solution before they can go into a prime loan, we're your best bet. Otherwise, you're locking them into something at a higher cost of capital for a longer period of time. It's going to have some expensive break fees and that kind of thing. So if you look at your 5-year or 6-year time horizon with your client and go, how much are they going to pay in interest over this if I do a neighborhood plus a prime? We might be lower. So educating the market, I think, is important. And, our losses have shown that this is a really good asset class and our returns are really, really great as well.
Makes sense.
Yeah. So we went pretty deep on the acquisition there, and very interesting to hear what you guys see for kind of the future of the industry too. But Jared, you and I initially connected through CAMLA, which I know you have a big part of. We joined CAMLA earlier this year upon the creation of our MIC. But we've talked about CAMLA a couple times on past shows, but I'd love for you to kind of go a little bit deeper and talk about your involvement with leadership at CAMLA and its importance in promoting the Canadian alt space.
Yeah, CAMLA is super important. I actually find myself really fortunate to be on the board at CAMLA and chair the compliance, actually Martha Kane, our CCO, chairs the compliance committee. I chair the communication and marketing committee there. So Neighbourhood is actually deeply involved. And then Ted, he was kind of voluntold, but he's a super helpful guy. Now is helping with and you probably heard me mention his name in one of the town halls, putting together the survey and updating it and everything. So CAMLA exists to really elevate the alternative lending space and also advocate for our space. And we do a lot of communications with regulators. They ask for feedback. We provide them with written feedback. They also invite us to various calls to give them feedback. So it is really, really important that we're at the table in those conversations, because some regulators don't really have a full understanding of the space. So to have those regular conversations with them, where say if they're thinking about proposing a rule, or you can give them feedback, let them know how it would impact your industry, but also advise on, what are all the other impacts that might occur, is super important. Because you, as a regulator, I think they have a tough job because they don't know exactly how all businesses operate, and they roll out rules with the best intentions, but it's really hard to understand all the knock-on effects of a rule. So it's really important to be in those conversations. And I would say that I'm so fortunate to work with the board because I mean, Adam Dean at CMLS might be younger than me. I don't know. He looks young, but he could also be older. But I think him and I are the youngest on that board. So there's a lot of experience on there. And Hallie is also on the board. And, that I actually feel fortunate that I've been able to work closely with her for the last couple of years before this acquisition, because I just know how much of a powerhouse she is. So yeah, I'm just fortunate and actually really grateful for CAMLA. And I think if there's any other mix out there that aren't members of CAMLA, this is the CAMLA pitch, please consider joining CAMLA. You will get your money's worth out of it.
Yeah, I can vouch for that too, Jared. In the short time we've been a part of it, there's just even the data that you guys share and the insight you provide, you can't get that anywhere else. So obviously in our industry, there's just not much data readily available. So it's been super helpful for us to bring that back and discuss with our team and kind of shape our strategy around some of that as well. So
yeah, one other thing I would just add is on the education piece. Like, all businesses are kind of siloed in a way, and there's not like a course on mortgage recovery in Canada, or mortgage collection in Canada, or there's not all these like really niche courses. So CAMLA also gives an opportunity for us to get together, discuss best practices, and then we can all borrow pieces from that for our own policies. So
very cool. Neil, you want to go to the last one there before we hit with them with the bonus?
I do want to ask one other question, and that would be from both of you guys. Maybe what would be your advice for a smaller lender or a smaller MIC like ourselves to grow? Obviously, origination seems to be something really important. Is there another piece that you would say is like, this is crucial for you guys in the coming years to stay focused on and make sure is done well?
I'll lead. I think just this gives you a little bit of a perspective on my view of the market right now. Survive. I would be, for real, I'd be less focused on growth, or at least in the short term. We all want to grow, right? We just did this deal specifically to grow, but the reality of it is we're still in a correcting housing market, and if you get too far ahead of your skis on some bad loans, it's going to hurt your reputation. It's going to hurt your ability to attract capital, which is ultimately the fuel you need to grow. So I'd be patient. Otherwise, we're hearing rumblings of some groups that grew really quickly in that kind of 22, 23 era, and or 21 to 23 era when prices were sky high and rates were rock bottom. And it's probably the worst time to want to accelerate your growth. And we're not in that today, but there's a lot of uncertainty out there right now. There always is, but it doesn't take that many loans in Windsor and 2 new car factories closing to suddenly see those values drop significantly on something you thought was maybe safe. So that'd be my advice, and build a track record. Like, one thing we've said in our group is that we're long-term greedy, and that we're on a 20-year march. So we're not too fussed about the month to month or even the year over year, but we just care about the trajectory.
Are you a private mortgage lender in Ontario looking for trusted legal support? Meet Grecky Carter Professional Corporation, a boutique real estate law firm in Midtown Toronto with deep expertise in private lending and mortgage enforcement. Grecky Carter closes hundreds of private mortgage deals every year, and when recovery becomes necessary, they handle both contested and uncontested enforcement with precision, from forbearance agreements to power of sale and cost recovery strategies. For lenders who demand clarity, efficiency, and results, Grecky Carter has you covered. Visit gclaw.ca to learn more and safeguard your private lending investments.
So I think for now, that's, we went, and Jared knows we've been through a few of these things, like even through COVID. It's like number one goal when the world shut down, let's just survive. Let's keep our team, let's keep our investors. We don't know what this is going to be like. We'll survive. We'll do what we need to do that. And I think we're still in a bit of that kind of environment. Like the world is literally still feeling the ricochet effects of all the I mean, you can even go back to the financial crisis in '08, but we're still sort of wrestling with money printing and weird rate policies and monetary policies and asset inflation and demographic problems and all this stuff. So yeah, we're lenders, right? Like, you got to be cautious. If you want to take the big swing, you got to go be a developer or an AI person or something. But we're just trying to get our money back. It's all it is.
Yep.
Yeah.
Well said.
Yeah,
I'm with you, Taylor. I share your sentiment.
Yeah, I'm. Taylor said it really well. The other thing I would add, and we say it a lot in office, is structure, process, discipline. Those are the three words. It's like, have the structure, build the processes, and maintain the discipline. I mean, that applies to all functions of the business. It even applies to life. If you have a training routine, Taylor talked me into signing up for High Rocks in Vancouver on December 20th. And I was doing 100 burpees this morning, and I regretted my decision. But I have a structure, I have a process, and I just got to keep up that discipline. And I would say, with that discipline, one deal is not worth risking your business over. So, Neighborhood, because of our conservative nature back in the day, we're still conservative, but we had to say no a lot, right? People would say, "Oh, you won't succeed. I can send you a ton of business if you just do this one deal." And it was just offside on risk, and we just said no. We just maintained that discipline. And so I think if you do that, then you can survive.
We've also done things like we've stopped working with bad partners, So
Yeah.
do business with people you like doing business with,
Yep.
that share your values. It sounds trite, but once you've seen it on the other side, like once you've seen groups that pressure you or get mad at your team or anything, and Jared knows I've been very clear about this basically from the beginning. Like, I don't care how much business we can do with them, they're cut. Like, it's just, life's too short to deal with that. So you can sometimes shortcut your growth maybe by working with groups like that, but then you're paying a price somewhere else, and might be the team quits or something. So we've just kind of stuck to our I like the structure, process, discipline. Just stick to your knitting, and there's not a lot of benefit in growing a lender super quickly.
I love that mindset.
Yeah.
Makes sense. Okay, well, that was great, honestly. Appreciate you guys saying this stuff. Last question we have here is, what was one thing you could change about the mortgage industry?
I think it's just one word. It's harmonization. Because for me, I'm the principal broker in DI. So for me, I see it all. There's a lot of rules that are very similar to each other in various provinces that are all trying to achieve the same, but they are slightly different, right? So this results in a massive admin burden, and it takes away the time brokers have to actually explain products to their customers and actually dive into the actual disclosure document that they're putting in front of the customer. I think as well, the regulators, they have the MBRCC, the Mortgage Broker Regulatory Council of Canada, which is a great effort in this. So kudos to them. But imagine if everyone just kind of had the same unified form, we don't even have the same terminology for agents and mortgage brokers across Canada. Like, those are just small things. We could just update it all. And imagine if the regulators could just meet and say, hey, how's this document going? Because then imagine, if you're in Nova Scotia or PI or something like that, they then will get the benefit of the work of the larger provinces. So overall, we can just, with the harmonization, we can just elevate the entire space, better protect consumers, also reduce the regulatory burden on companies like ourselves.
Yep.
Totally. With the volume in the alt space now, it makes sense.
Oh, yeah, 100%.
Yeah,
all right. Taylor, go ahead.
Well, I'd echo what Jared says. We do view that environment as a bit of a weapon that we can wield because we have the team that can handle it. But philosophically, I think we're one country, and it doesn't make sense to have 13 separate mortgage regulators. Even the lawyer in me is like, look, the nuance required in BC as against Alberta is just not required. Like, there's nothing so unique about each province, and it's the same on the security side. So if I were to advocate for something with Mark Carney, if you want to get rid of interprovincial trade barriers, just say, look, if you're compliant in your home jurisdiction, you can do business anywhere in the country. And then the onus is on making sure that those home jurisdictions do a good job, which they do. Like the regulators do a good job, and the rules are generally the same, as Jared says. But picking up on these nuances, and we're finding, even as part of this acquisition, to go back to it, just knitting together the different licenses, and you got to pay this province requires a bond, this province requires this type of insurance, which is different than here. It's complicated. That should change, because that also does discourage competition, which means that ultimately consumers get less choice. And really, we should be trying to do the best we can for the end user.
Yeah, 100%. I feel that with our business operating over 4 small provinces that all have different regulating bodies and different quirks to the rules, it's a pain. But hopefully we'll see some changes going forward. All right, we're coming up against it, guys. We always ask a bonus question at the end. So you guys are both West Coast based. So are you both in Victoria? Or are you in Vancouver, Taylor?
Yeah, we're both in Vancouver, but Jared and I both have Victoria.
Both in Vancouver.
I did my undergrad at UVic, and Jared grew up in Victoria.
Okay. Yeah. Okay. So I actually want to focus on Victoria here. So I've never been to Victoria before. I've been to Vancouver a bunch of times, but Victoria is pretty much the furthest place in Canada away from us in Halifax here. So I really know nothing about it. So I'll ask 2 parts here. So if Neil and I are out visiting Victoria, what are we going to see, and where are we going to eat?
Taylor, I would say he knows the restaurants better than me. This isn't a cop-out really, but I think El Terrazzo, that's like one of the staples in Victoria. I don't know, Taylor, would you agree with that? You probably know a more niche spot.
Yeah, I've got 2 young kids now, so my literal appetite for finding new restaurants is down to 0. 10 years ago, I'd probably have a good recommendation. I can definitely connect you with the right people who know the right spots, but I have fond memories of going to a restaurant called Pagliacci's, which is known for their greasy ciabatta bread that's unlimited. It's really great. Mm-hmm. The other thing, I'd say Victoria is really known. It's almost like it's its own thing, but it's almost like Portland in that there's just really niche-y things in it. It attracts that type of clientele. So for me, every time I've been going to the Victoria office, which is frequent, I always find time to get a nice coffee. So my favorite spots are Habit, which just opened up when I was finishing my undergrad, whatever that was, I don't know, 15, 20 years ago. And it's still around. It's still great. And then there's a place called Hey Happy, which just has such a nice name. So I like going to Hey Happy. And then there's a new one called St. Cecilia, which is, these are all kind of downtown. If you're taking a float plane or if you find yourself staying downtown, they're there. So that's kind of the vibe. Victoria, I've been to Halifax too. And I often thought Halifax would be like a mini Victoria. It's not. They're actually quite a bit different. Victoria is definitely has a lot of that kind of Portlandy hipster, real lifestyle oriented kind of vibe to it.
Yeah. Awesome. And I would just add, for a thing to do, I know Halifax is right on the water, but this is West Coast water. It's different, Pacific versus Atlantic. But renting a bike and just riding on Beach Drive, or even just driving through is totally fine. I'm a cyclist. Taylor's a massive cyclist as well. It's one of my favorite places to cycle. I think, it's just so gorgeous there. There's so many beautiful spots. But even from Vancouver, we can see the ocean from part of our office here. And the ocean in Victoria just, I'll use a younger term, but hits different. You can smell the salt in the air. Yeah. And the wind that comes off the ocean is much cooler. And there's, floating bull kelp and there's, fog and mist off in the distance. And then you see the Olympic Mountains. And it's just so picturesque and beautiful in some of the spots. Victoria, I grew up there, so I'm biased, but I just love some of the views. Just walking by the water is just amazing there.
Very cool. Definitely a bucket lister for me, and I appreciate the coffee recommendations. Big coffee fan, so I'll keep those on the list for when I do get out there. Neil, anything else to add before we wrap?
No, that's great. Really appreciate it, guys.
Yeah, great
thanks.
insight, guys. Really appreciate your time, and congratulations again.
Yeah, thanks a lot. Thanks for having us.
Yeah, thanks so much.
Thanks for listening, guys. It's Neil, your co-host and co-founder at Keystone Mortgage Investment Corp. and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan MacNeal. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.